This is Bloomberg Intelligence.
Spotify have always had fantastic user momentum.
Solar energy, the fastest growing corner of the energy market by far.
In-depth research and data on 2,000 companies and 130 industries.
The talent wars are right around Wall Street, but the buy side is plucking off of the sell side.
Aldi was the fastest growing grocery chain in the United States last year.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
We got a lot to cover. We're going to take a look at some regional banks today and how they're faring amid some failure chaos.
Plus, is the pet economy set to expand?
I love the pet economy. All right, first, we want to talk about UBS and the deal terms in UBS's emergency acquisition of Credit Suisse that could trigger some unknown risks. So for more on this, we're joined by Bloomberg Intelligence senior banks analyst Alison Williams. Broad strokes, is this a good deal for UBS?
I think it will be. I think it will turn out to be a good deal, and that is primarily because of all of the protections that they have sort of put in place. Beginning with the very discounted valuation, the AT1 securities, which basically got wiped out, very controversial, but that's basically, they did that so that UBS would have that further protection within their regulatory capital. And then after the first $5 billion of losses related to some non-core assets, the government's going to take $9 billion, and then according to management, they're going to split the rest thereafter 50-50. So a lot of protections built into place, and 74% increase in their tangible book value per share on day one.
And Alison, but this does change, I guess, maybe the investment call in this stock, which was, hey, kind of private wealth management, not going to take a lot of risk, maybe buy back some stock. Now they're kind of doubling down here on some bigger assets. Are some investors skeptical?
Well, it's definitely a near-term challenges the investment case and changes it from basically the strong, stable, biggest buyback bank that was out there. So now it is going to be a case of uncertainty. Again, in the long term, I think it works out, but the near term is challenged by the fact that you're going to have significant dilution by all the restructuring. Keep in mind that Credit Suisse was projected to take a loss this year just from their own restructuring, and now there'll be added charges as UBS and Credit Suisse combined. With all the overlap, they're targeting something like $8 billion, but that's many years out. It's a 3 or 4 restructuring. So you have the 3 or 4 year restructuring. There's a lot of execution risk around it. One of the big questions that we have is revenue attrition, and it's hard to look at a precedent just because the overlap of these two banks and the buybacks are paused, at least for now. They did say that their capital ratio, they're above their target. But also this was put together in a very short period of time. And as the UBS CEO was speaking, you could tell that, he was referencing the slides in terms of answering some questions himself. And so that the $8 billion is impressive, but they don't even have the details really on where, how exactly they're going to do that.
So typically when a bank gets bigger, it just gets riskier, because it's just so big that it's harder to execute internal controls and, you're integrating and all that kind of stuff. Is UBS going to be a fundamentally riskier bank after this? I know they're going to say no, and I know that they're going to want to pare back the investment bank, et cetera. But still, is this going to be like a Titanic that you just can't right quickly anymore?
I think in the immediate case, it is bigger and riskier, right? In the immediate case, you are going to be adding these assets, and you do have execution risks as they bring together these businesses. But I think one important thing to note is that this is not the Credit Suisse of 2 years ago. In fact, we were just looking at their trading operations, back in 2019 or 2020, when there was some noise then around a possible combination, it actually would have increased their trading operation, increased the skew to that business. But at this point, Credit Suisse has already brought that business down so much, and they've been in the process of selling some assets to Apollo, as we know. And so actually, pro forma, trading is actually going to be a smaller share of revenue. And I think that what the cushion does is allow them to be more expedient in terms of getting these non-core assets off their books, because that was going to take a while, Credit Suisse, and I think the ability to have some loss protection will help them to get the books off a little faster, clean that up. And then the asset and wealth management business, that is a business that, when combined, really benefits from scale. There's definitely some complementary things that UBS is getting in terms of that business, especially Southeast Asia, Latin America on the wealth side of things. And then in the investment banking business, which is capital light, as we know, getting some of their tech expertise.
Alison, thanks so much. I can't imagine how horribly busy these last couple of weeks have been for you. Alison Williams, a Bloomberg Intelligence senior banks analyst.
European bank AT1s are expected to trade lower after the Swiss decision to write off Credit Suisse AT1s while leaving shareholders with some recovery. For more on what that means for AT1 investors, we're joined by Bloomberg Intelligence senior credit analyst Jeroen Julius. Jeroen, for 99.9% of the people out there, can you please define what an AT1 is?
Yeah, sure. So AT1 stands for Additional Tier 1. It's an instrument that's used by banks mostly outside of the United States for their regulatory capital purposes. They are the most junior bonds in a bank's liability structure, and they sit just above common equity, so just above the shareholders. And they share with common equity, they share some equity-like features. These are perpetual instruments. But they do have a call option, an issue a call option, typically after 5 years, could be 7 years, could be longer. They have a discretionary coupon, so that's not dissimilar to a dividend for a stock. And they've got a principal loss absorption language. So there's a trigger in the bond documentation that specifies that the instrument will be either written off or converted into common equity, and the write-off can be permanent or temporary. It depends on the jurisdiction, so there is some variation in that language.
So let me stop you there, because this is important, the jurisdiction and the language, because when AT1 holders were wiped out after Credit Suisse was bought by UBS, there are a lot of unhappy people. But what I've read is that if you look in the actual contract, what the Swiss government did with these AT1s for Credit Suisse was totally legit versus maybe some other contracts for some other banks that have AT1s. Can you walk us through, as jargonless as possible, which I appreciate, with AT1s is tricky, if what the government did was okay?
Yeah, well, you're absolutely right. It is clearly stated in the risk factors. So it's not in the terms and conditions. In the terms and conditions, it specifies how a write-off would work. But the risk factors are also important, because there you can understand how AT1s will be treated relative to other layers in the capital structure of a bank. And there it clearly states that the normal priority of claims, so the claims hierarchy, can be completely ignored by the regulator, in this case FINMA, in Switzerland, if it decides to impose losses on those instruments. And I think that has caught many people off guard, because Switzerland, the banks, the authorities, they would pay lip service to respecting the claims hierarchy. So and not just them, everywhere, right? Everywhere in Europe and beyond, the claims hierarchy is central, right? What we saw, however, after Credit Suisse is that the AT1 holders, so the bond holders of this junior layer in the capital structure, they were completely wiped out, whereas the shareholders of Credit Suisse walked away with 2-3 billion Swiss francs, which is not a lot of money, but that's not the point, at least not for the bond holders.
Right.
The point is that the principle of the priority, the claims hierarchy was completely ignored, turned on its head, if you like.
All right, so the Credit Suisse bondholders, they lost their value. But this is a bigger market than Credit Suisse. Banks across Europe have AT1 bonds in their capital structure. How have those bonds traded in the aftermath of Credit Suisse?
They all traded down a lot. Across euros, they were down by between 4 to 8 points, and that is a big move for a bond. And in dollars, by between 6 to 12 points, even a bit more than that. sell-off was universal, so it wasn't name specific. UBS did underperform a little bit in dollars, also reflecting the fact that in buying Credit Suisse they are taking on lots of extra risks. So that was the driver of the underperformance. But again, AT1 sold off across the board, but it's still a very the sentiment is still pretty poor, I would say.
So then, to that point, does this mean that banks are not going to be able to issue this kind of capital anymore, or do they have to just revert to different kind of capital?
Well, that is the big question, because there's a lot outstanding. Now, this is not a small market. So European banks started issuing AT1 bonds back in 2013, and then it took a few years for the market to grow to its current size. But pretty much every European bank has some AT1 issues in its structure. It's an efficient instrument to have in your structure to meet Tier 1 regulatory requirements. And I won't go into that because that's probably getting it too technical, but it is an efficient way to meet your regulatory requirements. So everybody's got them. It's a large market, and a lot of those bonds are outstanding. And the way it works typically, or worked until now at least, is that those bonds, when they came up to their first call date, that the bank, the issuer, they would call this instrument and replace with a new bond. Although the sequencing would be the other way around, they would probably pre-issue a new bond and then call the old bond. But the question now is what's going to happen. For the rest of this year, will issuers be able to issue new AT1s to call their existing ones? Mm-hmm. We don't know. It depends on is sentiment going to improve? Are yields going to come down from their current levels? Mm-hmm. Because right now it seems unlikely to see any issuance in the very near term.
Great stuff. Amazing work. Thank you so much for clearing that up. Jeroen Julius joining us from Bloomberg Intelligence. He's Senior Credit Analyst.
Coming up on the program, we'll get the latest on the legal side of UBS's Credit Suisse deal.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
UBS's March 19th deal to acquire Credit Suisse comes with baggage, specifically the latter's litigation portfolio. For more on this, we're joined by Bloomberg Intelligence Senior Litigation Analyst Elliott Stein. So, Elliott, they're getting a lot of good assets from Credit Suisse, but they're also picking up some litigation liabilities potentially. Walk us through it.
Yeah, so Credit Suisse has had a lot of litigation issues over the last few years. They've been able to resolve a lot of it, but there are still a few items outstanding that are notable, including Archegos. There's still some legacy RMBS litigation from the financial crisis, if you can believe it.
I can.
Yeah, right, exactly. There's litigation related to what's known as XIV, which is an inverse VIX exchange-traded note. There's some Greensill litigation over in the UK. But so that gives you a little flavor of what's still going on.
So from what I understand is that UBS is responsible for the first 5 billion francs, and then the government's going to kick in 9 billion francs. What I'm not clear on, is that for litigation? Is it for losses if they have to sell stuff? Like, can they use it for this kind of thing?
It's a great question, and I haven't seen any indication that backstop is for litigation.
Really?
Yeah,
That's interesting.
I just haven't seen anything one way or the other. Mm-hmm. So my assumption right now is that it's not for litigation. But in any event, all the litigation risks that I just outlined, I think, are well below $5 billion. So I don't even think it would come up.
And this is different from, I'm thinking back to J.P. Morgan buying Bear Stearns, Washington Mutual. Mm-hmm. When, they didn't know what they were getting. I mean, if I'm UBS, do I know what I'm getting on the litigation risk side?
Yeah, I think UBS has a much clearer picture of what Credit Suisse's litigation exposure is currently versus what B of A got when they bought Countrywide 15 years ago and J.P. Morgan and Bear Stearns. To use the parlance of Don Rumsfeld, when the Iraq War started, I would say UBS, what UBS knows about Credit Suisse is known unknowns, whereas, for B of A, it was like unknown unknowns. There was a whole universe of things that were still evolving, and they just really didn't have any sense of where all that litigation was going to go. Now, I think we sort of know what the worst case scenario is for Credit Suisse's litigation.
I guess I'm also thinking about any lawsuits related to the AT1s, any lawsuits for shareholders, even UBS or Credit Suisse shareholders.
That's sort of where maybe the unknown unknowns come in, because I do expect to see bondholder litigation over the complete write-down of the AT1 notes. But I will say I looked at the offering documents, and I think the language in those offering memos really allowed the government to do what it did with the complete write-down and to wipe out bondholders before shareholders.
Because that's going to be something interesting, because this is a new instrument, relatively new instrument, and I'm not sure the law is that well established. Boy, if I'm a AT1 holder, okay, maybe I didn't read the prospectus closely enough, but come on, the equity guys are getting some cash and I'm getting zip?
Yeah, but that's why you got to read the documents, Paul. Right?
I got attorneys for that.
Well, for sure. And
yeah, attorney.
It does seem like a lot of people did not read the bond documents closely enough, because it does provide for a complete write-down and for the order of priority not to be followed in that scenario when there's cancellation versus conversion to equity.
So what are some other unknowns? No, seriously. I know we're joking because they're unknown unknowns, but where might be the cracks that UBS needs to start thinking about? We have the current lawsuits. We have lawsuits from the AT1 holders, potential shareholders, etc. But in the business, are there any issues?
No, it's a fair question, because a lot of the ongoing issues, whether it's Archegos or Greensill, RMBS is different. I'll put that aside. But material weakness in their internal controls, which they just revealed with their annual report last week. These all really have to do with risk management processes. So who knows what other bodies are lying around in terms of risk management lapses?
So just in a typical M&A transaction and acquisition, Elliott, if I'm the buyer, don't I say to this seller, any litigation that arrives after we do this deal that hasn't been disclosed, that's on you? Don't I say, if you did a dumb deal 3 years ago and now the suit's been brought in after I buy you, am I not indemnified against that?
I think in a normal situation, yes, but this is a distressed situation where Credit Suisse can't really do that, right? This is the whole purpose for this transaction, is that that UBS has to come in and save Credit Suisse, so it doesn't, that indemnification really wouldn't mean all that much. But as it is, Credit Suisse does have 1.2 billion Swiss francs in terms of litigation provisions.
Okay.
So, I think a lot of their litigation risk, I think, will be covered by existing provisions. And UBS took additional provisions as part of this deal.
Do you think that anyone sues the Swiss government?
Possibly, yes. I think as part of the potential AT1 bondholder lawsuits that we anticipate, it'll be interesting to see if they're suing Credit Suisse as the issuer of the bonds, or the government for wiping them out, or both. And it'll be interesting to see what those lawsuits seek in terms of relief. Are they going to seek to unwind the deal or stop it? Or are they just going to seek monetary relief? It's an open question. These lawsuits will most likely be brought in Switzerland, so I'm not even sure, how.
Right. All right. So when I see an M&A article written on the terminal, you know what I do? I go right to the bottom of the article to see who the advisors are. Right. Okay. And the other place you can find it is you go MA-GO, and you type in UBS, and you got the financial advisors, which I go first. Which one of my banker buddies is getting paid? Who got shut out? Now we've got the legal advisors.
Yeah, that's where I always look first. See what law firms are involved. See which of my friends are.
These folks get paid too. So UBS hired Davis Polk and Wardwell, know them well. White Shoe, New York firm. Freshfields Brockhaus, I'm guessing it's a German thing.
Actually, I think that's a UK firm.
Okay, and then
but very notable, good firm.
And then for the seller, we got Cleary Gottlieb,
great
also
firm.
a big
represents Credit Suisse in a lot of things.
Is that right? Okay, okay. And Hamburger, I'm guessing that's that's
probably a Swiss firm.
And then Sullivan and Cromwell. These are the blue chippers.
Yeah,
right?
Elite of the elite. Yes.
So
I wish they'd hired me.
So that's why. When I look at that, I'm like, they're smart people there. They figured it out.
That's what. Absolutely. Yes, I just put out a note actually saying that any litigation challenging this deal is going to be difficult. It's probably inevitable, but it's going to be difficult.
Hey, do we have league tables on the terminal for lawyers?
Wow, that's a whole
nother thing.
That's a whole other thing. All right,
I'm not sure those are disclosed.
Okay, so what else are you watching? It's been a really crazy couple weeks in the banking system. What's on your radar right now?
Well, related to some of the regional bank fallout, we have started to see some shareholder securities fraud lawsuits brought there against Silicon Valley Bank and against Signature Bank. So far I haven't seen any indicia of fraud. I mean, I think there was probably mismanagement at those banks potentially, but fraud is a whole nother level. And until I see better evidence of that, I don't think those lawsuits are going to go anywhere.
Are there any big cases out there that you're paying attention to, just in terms of litigation, that if they go one way or the other, we're going to hear about it? Like people like Alex and I will even hear about it?
What a really interesting area of law right now is where there's like new precedent being set is crypto, believe it or not, because it's such a novel area. And, maybe the audience is a little nichey, but as a lawyer, there's some really interesting legal cases.
All right. Good stuff.
You just lost Paul on that. He's like, oh, man.
Yeah, I got Bitcoin on my screen. I'm hip. All right, thanks to Bloomberg Intelligence Senior Litigation Analyst Elliott Stein.
All right, coming up on the program, we're going to take a look at the future of the pet economy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. International growth in pet populations, coupled with an increased willingness to spend, may drive the global pet market to $500 billion by 2030. For more on this, Bloomberg's Kriti Gupta and I spoke with BI Senior Equity Research Analyst Ann Hunter Van Kirk and Consumer Staples Analyst Diana Rosero-Pena. And let's start with you. I'm not buying it. $500 billion on pets?
It's a huge number, Paul. You're absolutely right.
All right.
That growth will definitely...
Sell me on it.
It'll definitely be mostly driven by the pharmaceutical side, the healthcare side. That's diagnostics, prescriptions, largely in pain, parasiticides, also dermatitis. But the larger portion of the market, while the healthcare side is the growth side, is Diana's consumer staple side.
Yes, for sure. Food will be the biggest expenditure on pets. It's going to be about 28% of the market, will remain that way for the foreseeable future, and the U.S. is going to be leading in that.
I buy it. I have a dog. I get it.
You're a dog person.
I'm happy to spend a good chunk of my income. Paul doesn't have a dog, guys.
No.
So
No.
And he doesn't want one. But walk us through the numbers on here. I mean, we were talking about $500 billion, but I mean, not everyone is as obsessed with their puppy as I am. How do you kind of incorporate inflation, for example, in that thesis?
Inflation is a big part of it, but we'd actually push back that everyone is as crazy about their pets as you are. The U.S. is certainly the biggest market, with Europe and the rest of the world smaller, but also still growing a ton. Part of that is from pet populations. They increased a lot during COVID, 6% I think it was in 2020, 4% 2021, still growing 2022. And the drivers are the humanization of pets, that people are willing to spend more. That's going with younger generations, significantly willing to spend more, maybe pets over creating families even.
Wow.
There's a lot of growth there.
She looked straight at me when she said that.
No judgment. No.
So, and on the pharmaceutical side, the medical side, is there doggy insurance, doggy health insurance?
There is.
Is that a thing?
It's a nascent market for sure. It's only about 2% penetrated.
Because everything else is out of pocket for everybody?
That's why it's a beautiful market, actually, to begin with. It's all cash pay, increasing a ton. People are more willing to spend on like diagnostics, fecal and blood tests for their pets. But the insurance market is small right now. It's really with the traditional insurers, but some of the Chewy's has done some partnerships with Trupanion, and Zoetis has gotten into it as well, a traditional pharmaceutical manufacturer with their pumpkin insurance. We don't see the insurance market growing to anything close to human coverage of lives, but we do expect it to grow. Right now, dogs are ahead, maybe 4% penetration, and only about 1% with cats.
As a pet owner, I got to say, when you raise a puppy, the vaccinations alone, you want that insurance because it'll really cover a lot of the expenses, not to mention surgeries when your dog gets older. We're talking about like thousands of dollars, Paul.
Okay.
Regardless, I got to talk about the players here. You mentioned Chewy. I'm reading your research. This is fascinating. Chewy and Amazon leading the e-commerce share, but still brick and mortar, nearly 3/4 of pet shopping. That is wild. Why are pet owners not doing e-commerce?
Well, they are, but it's obviously e-commerce penetration is about 21% of the market at this point. We expect it to reach 30% by 2030. Spending on brick and mortar will remain because people go to these places to do a one-stop shopping for all the family, and that includes their pets. So obviously, Walmart, Target, those will probably get the expenditure of the business for the foreseeable future.
You know, in my building, we have a very angry pit bull by the name of Harry. A lot of anger issues with him. But he gets his Chewy box every couple of weeks, so it's a thing. Diana, what else are people buying for their pets? It's not just pet food, because I'm seeing some numbers here, and it can't just be the kibbles and bits.
Well, there's going to be expansion in fresh frozen, what we call fresh frozen, which is food, but it's healthier food for dogs. Fresh Pet has 90% of that market, but we're counting that it's going to probably reach an 11% penetration over the next 5 years of food, fresh frozen. So, that is going to be the biggest expenditure for the foreseeable future. Now, other things like services, you have hardware, the toys, the Pets Destroy, of course, that is a very profitable part of the business for these companies. But yeah, for sure.
I love that you are talking about kind of the humanification of pets, because I got to say, I feel like I have conversations with my dog sometimes.
And does he or she talk back?
It barks back.
Okay.
It's a whole dynamic. Paul's not a pet owner, guys, so he doesn't get this.
I don't get it, but I know that people do get it, and I respect
people
that.
do get it. People do get it. But look, I think it's fascinating on this fresh frozen story. It could actually benefit producers like General Mills, Nestle, Smucker. Those are not brands I associate with pets necessarily.
Well, but they do have pet brands. Smucker, General Mills with Blue Buffalo. General Mills Blue Buffalo is expanding into fresh frozen. That is probably going to be competition for Fresh Pet. But yeah, these big food companies are interested in adding their exposure into pet. You have Post Holdings that they bought a significant share of significant brands from Smucker for $1.2 billion. So it's happening.
It's real money. All right. And one question for you. The human population is aging. Is the pet population aging as well? And is there healthcare implications for that?
It is. That is a big growth driver of it. And it's really also driven by better nutrition coming from Diana's side. That, whole foods of pet foods that's growing is driving longer pet lives. And aging pets, just like aging humans, require more expensive care. Their diagnostic tests typically require more follow-up, and they're increasingly complex therapies. We now have monoclonal antibodies approved for pets, and people are paying for it.
Global pet market, $500 billion by the end of 2030, so forecast Bloomberg Intelligence. How about that? Our thanks to Bloomberg Intelligence Senior Biopharmaceutical Equity Analyst Ann Hunter Van Kirk and Consumer Staples Analyst Diana Rosero-Pena.
Failures in the banking space. Regionals front and center. What's next? Who's at risk? Who's going to buy what? What are going to be the rules going forward? There's really only one person in Bloomberg Intelligence to ask this question to, and it's Herman Chan, Bloomberg Intelligence Senior U.S. Regional Banks Analyst, who said to me the other day, it's his 15 minutes of fame. I feel like it's been extended to 20 minutes of fame at this point.
20 minutes is pretty good.
Yeah, okay, we'll do 20 minutes. As you look at the banking landscape right now, what banks are you most concerned about? What are the characteristics that they have?
Sure. So the issues that have felled SVB and Signature were largely related to deposits. They had very chunky commercial-related deposits that if there's any sort of fear in the markets and there was a deposit flight issue, then if you get a handful of those chunkier deposits leaving, that creates a hole in your balance sheet. So chunkier deposits is a red flag. We've seen some banks that screen a bit poorly on that front in terms of less deposits that are under the FDIC insurance limit of $250,000. First Republic fits the bill on that front as well, which is one of the reasons why you've seen the market consternation with the name, and you've seen deposits really exit from that balance sheet as well.
One of the things I've learned this past couple of weeks is this whole concept of asset liability management, making sure that they are managed well. And you could argue that maybe they weren't at certain banks. Does this suggest that banks in general, regional banks in general, may become more conservative about how they manage that risk?
I think so. The rule of thumb prior to these last few weeks is that deposits are generally sticky and stable, and you have strong relationships with your customer, and they wouldn't leave you if you had a historical relationship with them, and it wasn't transactional. I think First Republic is sort of the poster child with this, where they've always historically talked about in their press releases and their presentations about how strong their deposit relationships were. Mm-hmm. And unfortunately, that unraveled just so quickly. So there has to be a rethink and a reset within the industry in terms of how sticky are your deposits? Do you try to take in more retail deposits that are under this FDIC insurance limit, or do the regulators in Congress increase that limit to add some more stability to the overall banking system? So that's something that is on the table.
Putting that one aside for a second, the deposit issue. I was talking to some individuals on television this week, and Gene Ludwig being one of them, and he was saying, look, we do not need more regulation. What we needed was regulators to not be dumb. I'm paraphrasing. And for media to calm down.
Right.
That this was the first kind of digital run on the bank, and it really taught us a lot in how quickly this can actually spread, and that we didn't need more regulation. We didn't need smaller banks to be regulated differently. Everything was fine. Everyone needed to do their jobs. Is there truth in that?
I think so. You've just seen with the case with SVB just the fact that information flowed so quickly, and you see on Twitter, in real time, folks concerned about that institution. You see in real time the market losing confidence, and it was a vicious cycle where you had VC folks come out explicitly and say, we're taking our startup money away from SVB to a bigger bank. And that just happened in a day's time. And we've never seen a bank fail so quickly with the size like SVB. So I do agree that there's some factors that are underappreciated prior to this whole episode. And the fact that regulators probably needed to be a bit speedier in terms of finding a resolution for SVB, finding a buyer. It's taken such a long time that typically the resolution takes place a bit more quickly. And this time the regulators seem to have dragged their feet a little bit.
So many of our listeners remember the great financial crisis of 2008, and that was, a double underlined crisis. Mm-hmm. Some people today are calling this a crisis. I'm not one of them because it doesn't. I lived through that, and it just doesn't feel anything like it. How do you compare and contrast kind of what we're dealing with right now to, what was, the great financial crisis?
Sure. We've seen banks rise and fail. At this point, there's only a handful of banks that have really gone under. I wouldn't call it a crisis. I would call it some market turmoil and some issues with banks taking risks that they underappreciated during the prior zero interest rate environment. And those risks has really come to the fore, and there's repercussions to those mismanaged risks. It hasn't really proven systemic at this point. Regional bank earnings is coming out in a couple weeks, so we'll hear more in terms of expectations on deposits and deposit outflow during the first quarter. But at this point, I'm not ready to say it's a full-fledged bank crisis either.
Do you think, though, we are going to see any kind of rapid roll-up with some of these banks? I mean, I appreciate that SVB is a long, lingering process, but this will spur a lot of M&A.
Sure. Well, we've seen New York Community come in and already purchase a large chunk of Signature's remaining deposits and a smaller portion of their loan book. So we're seeing in real time some winners emerge. If we don't get a full-fledged crisis, then there's not going to be too many opportunities for a roll-up. First Republic is one that is still something that needs to be focused on, but overall, there's really only a handful of banks that are really in the crosshairs now. And if things do spread and contagion risk happens, then sure, that possibility is more real. But at this point, it's too early to say a roll-up opportunity is going to happen for these regionals.
So again, is this something that might drag on for a while? Because again, rates remain high, and there may be some mark-to-market issues for other banks. Should we be prepared for maybe some more of this, or has the eye of the storm passed, do you think?
So I would point to the regulators' communications during this entire ordeal, where the Federal Reserve is not in the business of bailing out any financial institutions anymore.
Yep.
I think we've learned that lesson. So they're a bit more cautious with what they roll out in terms of mitigating the concerns in the marketplace and concerns in the banking system. The liquidity facility helps. Janet Yellen came out recently and noted that smaller banks, the depositors of these smaller banks, could expect a backstop as well. So these are all measures to instill confidence without saying outright that we're going to bail out any bank that fails. So until we get some more clarity from regulators on a potential deposits blanket guarantee, really there's going to be some ups and downs, I think, going forward.
Herman, such great work. Thank you so much. Herman Chan, Bloomberg Intelligence, Senior U.S. Regional Banks Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.